Why peak inflation is near. Team Transitory hasn't given up hope of winning the great inflation debate. That was a tag given to everyone from the Federal Reserve Chair Jerome Powell on down, who expect the pandemic price spikes to be short-lived. With the inflation still breaking records all over the world, they essentially lost that argument. But remains plenty of economists who argue that the stock price will soon fade as supply blockages ease and energy costs stabilize. Some warn that central banks are in danger of making a big mistake by raising interest rates too aggressively, even as price pressure shows signs of peaking. With inflation now exceeding 8% in the euro area and expected to stay above that level in the US when May data comes out on Friday, here's a roundup of some of the main arguments laid out by the Team Transitory 2.0. The first one is too tight. Central banks argue that they can raise interest rates at a pace that allows the economies to achieve what's known as a soft landing. Skeptics say that they'll tip the economies into recession by tightening too much, with the inflation likely to undershoot targets again as a result. History illustrates the risk. The European Central Bank in 2011 raised borrowing costs only to be forced to reverse them later that same year, while the Bank of Japan in 2006 raised rates and had to unwind that move in 2008. Inventory glut. Ongoing supply chain blockages prompted retailers to stock up on the goods they need to ensure they can meet demand. With signs that consumers are growing cautious as interest rates rise, that's now leaving an overhang of goods that will add downward pressure on prices. Inventory rose $44.8 billion or 26% for businesses on S&P consumer indexes, with a market value of at least $1 billion, according to data compiled by Bloomberg of companies who reported earnings in late May. Economists at Morgan Stanley warn that the risk of an inventory glut is growing, especially in sectors such as consumer discretionary and technology goods. Housing falters. House prices soared in many countries during the pandemic, thanks in part to central banks bringing interest rates to historic lows and pumping money into the economies by quantitative easing. While housing prices aren't always included in inflation baskets, rental costs are, and they often reflect the same dynamics. As inflation took off in 2021, borrowing costs started going up to tame it. There are now signs that house prices are cooling actually, so global growth in real house prices slowed to a 4.6% annual rate in the final quarter of 2021, down from 5.4% in the previous 3 months, according to the Bank for International Settlement. In real terms, they estimate that global house prices exceed the immediate post-global financial crisis average levels by 27%, suggesting plenty of scopes for a correction. So, as interest rates rise, so will the repayment burden on consumers. Now, let's look at the China effect. China's slowdown, driven in part by new COVID restriction, will be a deflationary shock for demand across the global economy. It's most likely to show up in commodity prices as Chinese purchase of everything from industrial metals to agricultural products and energy gets scaled back. Bloomberg Economics calculate that a 1% point slowdown in Chinese industrial production can shave as much as 5% points of global prices. China is the world's biggest buyer of iron ore, and it accounted for 40% of global demand for copper in 2020 and as much as 30% for nickel, zinc, and tin. Now, Japan's example. Japan is the world's leader in experiencing a long deflationary bust and has seen manifold dawns when the hopeful return of inflation couldn't be sustained. It's too early though to tell if this time will prove different. Consumer prices recently hit the Bank of Japan 2% target, driven by a surge in energy prices, but limited wage gains continue to keep consumers skittish. And the BOJ remains committed to stimulating Japan's economy on the view that the current inflation spike is transitory. I expect the world to swing back from historic inflation to disinflationary and deflationary pressures, said Takahide, an economist at the Nomura Research Institute in Tokyo and a former BOJ board member. Inflation will come down at the expense of monetary and policy tightening and an economic slowdown. The price trend will ultimately be dictated by the potential global growth rate, which is weakening due to the pandemic and the Ukraine situation. Now, well anchored. Economists at the Peterson Institute for International Economics identified a shift in long-run inflation expectations, partly due to better central bank policy, as one reason why the U.S. prices stayed subdued for much of that period. The public has expected that inflation, even if buffeted in the short run by shocks, would return in the longer run to its low normal level, they wrote. That expectation in turn has almost certainly helped stabilize actual inflation, and they noted that even after a year of soaring prices, long-term inflation expectations aren't much higher than they were a decade ago. Now, meanwhile, bond investors have been trimming their inflation expectations in recent weeks. And lastly, let's look at the base effect. Some of the current inflation spike has been magnified by what are known as base year effects. Essentially, inflation was high when year-over-year price changes were measured against the time earlier in the pandemic when economies stalled and most or costs slumped. But soon they will be measured against the current elevated level of price instead, so some of that effect will reverse. Regions such as Europe that rely on imported energy may see a greater fall in inflation than others if the price of fuel like oil and gas were to quickly cool. Commodity prices will start retreating, said Priyanka Kishore of Oxford Economics. They will remain high by historic standards, but they are likely to keep climbing. She expects that by mid-2023, food and energy commodity prices will drop by 10% to 15% from a year earlier, helping to bring overall inflation down.